Hi and Assalamualaikum warahmatullahi wabarakatuh. I will presenting about the effect of moratorium toward banking institution. Introduction. The Chinese province of Wuhan was the first to declare an outbreak of coronavirus in COVID-19 at the end of year. Malaysia, which is economically dependent, with the effects of the Movement Control Order (MCO), which is shut down nearly all the country's weather industry. Because of this circumstance, more people lost money. The banking industry, which is a subset of the broader financial sector, experienced a similar situation. The government and Bank Negara Malaysia (BNM) have implemented a number of fiscal and monetary policy measures to stabilize the economy of Malaysia. So, what is the moratorium? The term moratorium is used to characterize the temporary suspension of certain financial obligation or activities when government or regulatory bodies observe individual business financial distress. They may institute a moratorium in an effort to assist them. So, how moratorium affect the banking sector? Firstly, the liquidity and cash flow of bank can be significantly impacted by a moratorium. If a moratorium is in effect, borrower may be able to reduce their loan payment or stop making a payment. As bank cash flow decrease, this may contribute to liquidity issue. Another crucial factor that is affected by moratoriums is the assets quality of financial institutions. As debtors are given time off from making payment, non-performing loan NPLs are more likely to increase during moratorium. Lender classified as non-performing loan that have gone more than 19 days without payment. NPL can negatively impact the balance sheets and profitability of a bank. Third, moratorium may affect the solvency and capitalization of financial institution. Reduced loan repayment can disrupt a bank's cash flow projection, making it more difficult for those institutions to maintain healthy capital reserves. As a result, the capital adequacy ratio and efficiency indicator of a bank's health conditions could decline. If the bank's capital adequacy falls below regulatory standard, its solvency and ability to meet its obligation may jeopardize. Last but not least, the impact of moratorium on financial institutions extend beyond the monetary realm. Your credibility and your customers' confidence in you could be severely damaged. Even though a moratorium was enacted to aid debtors, it has the unintended effect of making consumers anxious about the long-term viability of their bank. Potential depositor may question the bank's long-term viability and its ability to weather a financial crisis. Negative public opinion is detrimental to the long-term health of bank, as it may cause clients to withdraw their fund and damage the institution reputation.